Hello everybody, welcome to Rao's analysis of Prelims 2020. In this particular video discussion, we shall be carrying out an in-depth analysis of the questions that were asked from Indian economy in Prelims 2020. Before starting with the video discussion, let me first highlight as to what is expected from this particular discussion. See, first and foremost, we will be carrying out an analysis of the trends in terms of weightage given to different themes in the Indian economy in the previous 3 to 4 years and analyze whether the same trend has continued even in Prelims 2020 or not. Secondly, in Prelims 2020, there were almost 20 questions from Indian economy. Out of these 20 questions, we will be carrying out an in-depth analysis of at least 10 questions. As part of such an analysis, we will try to find out as to what were the nature of questions asked, whether the questions were conceptual or whether they were current. We will analyze the difficulty level of the question in terms of easy, moderate, or difficult. Thirdly, we at Rao's, we come out with a number of material in order to help you prepare for the prelims examination. We have our prelims test series program, quality improvement program, which is normally held before the prelims, then the prelims compass, and so on. So as part of this particular analysis, we'll understand as to what extent these sources could have helped you in answering the questions asked in prelims 2020. So let us look at the trends in the weightage of the different themes with respect to the Indian economy. If you closely analyze the syllabus of Indian economy, you would be able to clearly identify some broad themes. These themes are banking and finance, international trade, government schemes, external sector, taxation, and core concepts. Out of these themes, as you can see, the most dominant theme happens to be the banking and finance. On an average, 5 to 7 questions are asked from this particular theme. And the same trend has continued even in Prelims 2020. The second most dominant theme happens to be the government schemes, policies, and initiatives. The same trend has been observed with respect to weightage of this theme. On an average, 5 to 10 questions are asked from this particular theme, and this year we had 6 questions. There is slight variation with respect to weightage of the core concepts. The core concepts are basically dealing with the microeconomics and other aspects. In Prelims 2019, we had 3 questions from this core concepts, but in Prelims 2020, we did not have a single question. As far as the questions which were asked this year, as I told you before, there were 20 questions. Now, most of the questions were conceptual in nature. So if a student had a sound conceptual understanding of various economic concepts, he or she would have got the right answer. Now, for example, there was a question as to what would happen if you withdraw 1 lakh rupees from your demand deposit account, what would happen to the aggregate money supply in the economy? So if a student has a sound understanding of what exactly is the aggregate money supply, he would have got the right answer quite easily. Similarly, there was a question as to which one of the following is a major characteristics of foreign direct investment. So if a student knows the exact definition of FDI, which is as recommended by Arvind Mayaram committee, as well as the difference between FDI and FPI, such a student would have got the answer quite easily. So most of the questions were conceptual and they were relatively easy, provided you had a sound conceptual understanding. But at the same time, we had almost 3 to 4 questions which were considered to be difficult by the students. For example, there was a question related to what constitutes the non-financial debt. Now, this is considered to be a little difficult because neither the RBI nor the government uses a term non-financial debt in its report. The Department of Economic Affairs comes. Similarly, there was another question related to the interest coverage ratio. So there were at least like 2 to 3 questions which were considered to be difficult by the students. But overall, the paper was on a level of easy to moderate. So if you had sound conceptual understanding of various themes of Indian economy, you would have easily got these answers correct. So let us start with the analysis of the 10 questions from the Indian economy.
Now coming to the first question, the question here is, if the Reserve Bank of India decides to adopt an expansionist monetary policy, which of the following would it not do? This question has been asked from theme of banking and finance. This question is conceptual current. That is, it is a question which is based upon the core concept of the monetary policy, but it is motivated from the current affairs. It is considered to be conceptual because if you have to answer this particular question, you need to have an understanding of various monetary policy tools used by the RBI, such as the SLR, marginal standing facility, bank rate, repo rate, etc. You are also required to understand as to what does the RBI do to these policy rates when it is following an expansionist monetary policy. But this particular question has been asked in this year's prelims examination because now the RBI is following the accommodative policy stance. Accommodative policy stance is in a way an expansionary monetary policy which the RBI is following in order to reduce the policy rates and inject more amount of liquidity into the economy. So what can you learn from this particular question in order to prepare for the upcoming prelims examination? See, first and foremost, the first key takeaway here is you have to read the question very, very carefully. This is a classical case of UPSC question where one can go wrong if you do not read the question carefully. See here, the question does not require you to understand as to what does the RBI do as part of expansionary monetary policy. Rather, the question requires you to find out as to what RBI is not likely to do as part of the expansionary monetary policy. So if you don't read the question carefully, you will not be able to get the correct answer. Secondly, it has been seen in previous year prelims that a number of questions have been asked with respect to banking and finance, wherein the UPSC has tried to test the core conceptual knowledge of the students related to the monetary policy tools. Nextly, see, whenever you are coming across any current affairs related topic with respect to monetary policy, please do link it to the core concepts. Unless you don't understand the core concepts, you will not be able to understand the current affairs related topic. For example, you must be aware that in the recent times, the Reserve Bank of India has come up with a number of unconventional monetary policy tools in order to inject the liquidity into the economy. Some of these tools include the long-term repo operations, the foreign exchange buy or sell swap, operation twist, and so on. See, if you have to understand all of these tools used by the Reserve Bank of India, first and foremost, you need to have a sound understanding of the core concepts. Once you understand the core concepts, then you would be able to understand these policy tools of the RBI as well. Since the topic of monetary policy is quite important from the perspective of the UPSC Prelims examination, we had this particular question in our Prelims Test Series program. In this particular question, we had tested as to whether the students know as to what action the RBI takes as part of various monetary policy stances. Now, in our quality improvement program for the prelims, we have discussed in detail about these three policy stances. We had highlighted that the accommodative policy stance is usually adopted when there is a slowdown in the Indian economy, and usually as part of such an accommodative policy stance, the policy rates normally reduce. That is, normally the Reserve Bank of India reduces all the policy rates in order to inject the liquidity into the economy. The exact opposite of the accommodative policy stance happens to be the calibrated tightening. This is adopted when there is a higher rate of inflation. So usually during calibrated tightening monetary policy stance, various policy rates either remain unchanged or they increase. Further, in our QIP video, we had also discussed about the various monetary policy tools used by the RBI, that is MSF, repo, reverse repo, and so on. So if you look at the question asked in Prelims 2020, the question was, which of the following the RBI would not do as part of the expansionary monetary policy? So obviously, as part of the expansionary monetary policy, the RBI would reduce the SLR, it will reduce the bank rate, it will reduce the repo rate, and it would also reduce the MSF. But the option which is given here is increase the marginal standing facility rate, which clearly here is not what the RBI would do as part of the expansionary monetary policy. Accordingly, the right answer would be B, that is 2 only. Now coming to a second question about the foreign direct investment. The question here is, with reference to foreign direct investment in India, which one of the following is considered its major characteristic? With respect to nature of question, this question is purely conceptual. See, even though this particular question seems quite easy, this question is little technical in nature. This is so because in the various options that the UPSC has given, UPSC has tried to play around with the economic words in order to create confusion in the minds of the students. It has used some of the core economic words such as listed company, non-debt creating capital flow, debt servicing, and so on. So if you have to answer this particular question, you need to have the right information. First and foremost, you need to have a sound conceptual understanding of what exactly is the foreign direct investment. In particular, you would have to understand the definition of the FDI, which is as given by Arvind Mayaram Committee and later on accepted by the Government of India. You would also have to know the differences between the foreign direct investment and foreign portfolio investment. Unless you don't know these three concepts, you would get confused in answering this particular question. And that is what basically UPSC wants. See, various aspects of foreign direct investment have been covered by us in our quality improvement program. As you can see, foreign direct investment is basically a foreign investment of 10% or more in a listed company. In case the foreign investment is less than 10%, then automatically the government treats this not as foreign direct investment, rather it is being treated as a foreign portfolio investment. As far as the unlisted company is concerned, in an unlisted company, irrespective of the threshold, that is irrespective of the money invested by the foreign investor, all such investment is compulsorily treated as the foreign direct investment. Now, this was a recommendation given by the Arvind Mayaram Committee, and the same has been accepted by the Government of India. So, if you come back to the question which was asked in Prelims 2020, see, the first option says that it is an investment through the capital instruments essentially in a listed company. See, the foreign direct investment can take place even in an unlisted company. So this option which is given here is wrong. If you read the option D, it says investment made by foreign institutional investors in the government securities, which we know it is the foreign portfolio investment. Option C says it is an investment which involves debt servicing. This we know from the conceptual understanding of FDI that this particular option is actually wrong. If you read option B carefully, it says it is largely a non-debt creating capital flow. See, when a foreign company makes an investment into India, it is actually non-debt creating capital flow. So the answer to the question that was asked in Prelims 20 is option B. Now, based upon this particular question, what are the key takeaways in order to prepare for the upcoming prelims examination? Now, if you analyze the previous year prelims questions, you would get to know the topic of FDI and FPI is quite important. Hence, from the perspective of the prelims examination, you would have to focus upon the important aspects of FDI, such as the top FDI sources, that is from which countries India has been attracting largest FDI, the sectors attracting the largest FDI into India, the sectors in which the FDI is prohibited, the sectoral caps. So with respect to sectoral caps, there is no need for you to remember the sectoral caps on each and every sector. Precisely try to focus on those sectors which were in news. For example, the sectoral caps on e-commerce, particularly with respect to the marketplace model and the inventory based model, the sectoral caps on the contract manufacturing, which was recently in news in 2019-20, the coal mining, multi-band retail, etc. As you can see in the QIP prelims videos, we have discussed important pointers for the prelims, particularly with respect to the countries attracting the highest FDI, top FDI sources for India, top sectors attracting the foreign direct investment, sectoral caps on different sectors. More importantly, we focus upon the sectoral caps, particularly with respect to the important changes in the FDI policy. So with respect to the upcoming prelims examination, you would have to focus upon all of these aspects which are likely to be asked. Now coming to a third question, the question here is, which of the following factors or policies were affecting the price of the rice in India in the recent past? This particular question is from the theme of government schemes and policies, particularly with respect to the food grain management policy of the government of India. See, upon reading the question, you would get to know that two options can perfectly be right. These two options are the minimum support price and the consumer subsidies. The idea behind declaring the MSP is to fix the minimum price of rice in the open market. And secondly, the government provides rice at subsidized prices through the National Food Security Act. So, among the options which are given here, you should try to find out those options in which we have both option 1 as well as option 4. Out of these 4 options, we can easily rule out option C because it has only 2 and 3. So, we are still left with 3 options, A, B and D. So, this question, if you have to answer, you would have to find out whether the government's trading as well as government stockpiling affects the prices of the rice in the open market or not. So if you have to answer this particular question, you need to have certain amount of right information. First and foremost, you would be required to understand the different stages of the public distribution system, particularly MSP, procurement, buffer stock, distribution of food grains, open market sales scheme of the Food Corporation of India. Secondly, you should also have certain understanding about the open-ended procurement policy followed by the Food Corporation of India, particularly its working mechanism as well as flaws. As you can see in the prelims test series program, we had asked a direct question related to the open-ended procurement policy. In order to answer this particular question from our test series program, a student needs to have a sound understanding of the working mechanism and the flaws of the open-ended procurement policy. Further, in our QIP module, we have discussed in detail about the government's food grain management policy, such as the minimum support price, the approaches used in order to declare the MSP, that is the A2 plus FL method, then the PM ASHA price stabilization scheme, which is used for checking the volatility in the prices of onions, potato and pulses, then the market intervention scheme, which is used in order to check volatility in horticulture and other perishable commodities. Apart from that, if you look at our economic survey analysis, which has been uploaded on the YouTube, in our economic survey analysis, we have discussed in detail about the various stages of food grain management. In particular, we are clearly highlighted about the market intervention, wherein we are highlighted that presently the Food Corporation of India follows the open-ended procurement policy, wherein there is no limit on the procurement of food grains by the FCI. So sometimes the FCI ends up procuring more amount of food grains than what is actually needed. Hence, the surplus amount of rice which it procures, it is then sold in the open market. So the government's trading here, which is carried out through FCI, also determines the prices of the rice in the open market. Apart from that, as you can see in our economic survey video, we had also discussed about the buffer stock norms which is maintained by the Food Corporation of India. So when the FCI maintains the buffer stock, obviously the amount of supply of rice in the open market reduces. So this reduction in the supply of rice would have an impact on its prices as well. So through this particular understanding, you can clearly come to a conclusion that the government's trading in the form of open market sales scheme as well as maintenance of buffer stock by the FCI clearly affects the prices of rice in the open market. So if you go back to the question here, clearly government's trading as well as stockpiling affects the price of the rice in the open market, and hence the answer to this particular question would be D. That is 1, 2, 3 and 4. So what can you understand from this particular question in order to prepare for the upcoming prelims examination? See, repeatedly questions have been asked with respect to minimum support price, particularly with respect to who declares the MSP, the coverage of the commodities under MSP. All these aspects have been asked in previous year prelims. In the upcoming prelims examination, we could get a question as to what methodology is adopted by the government of India in order to declare the MSP. We could get questions related to the price stabilization scheme, the market intervention scheme, the operation greens, then about the central issue price, details of which have already been discussed in our economic survey video analysis. So you need to prepare for all of these topics in order to have a comprehensive understanding about the food grain management policy of the government of India. Doing so can enhance your preparedness level for the upcoming prelims examination. Now coming to the next question. This particular question is with reference to the theme of banking and finance, particularly with respect to chapter of money market. This question is purely conceptual in nature. See, if you try to attempt this particular question, the most easiest statement happens to be the statement number 4. The statement here is zero coupon bonds are the interest bearing short term bonds issued by the scheduled commercial banks to the corporations. See, if you know the word coupon, coupon basically means interest. So when we say zero coupon, that means that they are non-interest bearing bonds. So easily you can come to a conclusion that statement number 4 here is wrong. Accordingly, you can rule out option B as well as option D. So you are left with two options, that is option A and option C. So if you have to arrive at the right option, you would have to know certain details about the money market instruments, particularly details such as what exactly is commercial paper, certificate of deposit, call money or the notice money, and so on. Now, in our QIP videos, we have discussed in detail about the difference between the capital market and the money market, wherein we have highlighted that the capital market is basically used in order to raise medium and long term capital, whereas money market is used in order to raise short term capital, which can range from 1 day to less than 1 year. So under the money market, we have different instruments. These instruments can be issued by the central government, the state government, as well as private sector. The central government issues short-term instruments in order to borrow for a period less than 1 year. These instruments include the treasury bills, cash management bills, ways and means advances. The state government issues ways and means advances. The state government do not issue the treasury bills in order to raise the short-term loans. As far as private sector is concerned, the private sector issues commercial paper, certificate of deposit, call or notice money. Commercial paper is almost similar to that of bond, except the fact that the maturity period of a bond is greater than 1 year, whereas commercial paper's maturity period is less than 1 year. Apart from that, the commercial paper, it is considered to be a form of unsecured debt because it is not backed by any form of collateral. Certificate of deposit is basically issued by banks and financial institutions. It is similar to a fixed deposit, but its maturity period is less than 1 year. Apart from that, the minimum amount that can be invested in certificate of deposit is at least 1 lakh. In case of fixed deposit, it can be as low as rupees 5,000. With respect to call or notice money, this is basically used for doing interbank transactions. So whenever one bank wants to borrow from another bank for a period of 1 day, it is referred to as call money. If one bank wants to borrow from another bank, that is for a period greater than 1 day and less than 14 days, that is for a period 2 to 14 days, then that is referred to as the notice money. Now, all of these details of the money market instruments have been covered by us in the QIP module. Accordingly, if you come back to the question asked in Prelims 2020, the first statement here is the commercial paper is a short-term unsecured promissory note, which as we have discussed is correct. The second statement is certificate of deposit is a long-term instrument issued by the RBI, which is wrong. The third statement is call money is a short-term finance used for interbank transactions, which as we discussed is correct. Accordingly, the right answer to this question asked in Prelims 2020 is C. So what can we learn from this particular question asked in Prelims 2020? First and foremost, you should understand the difference between capital market and the money market for the upcoming prelims examination. You should understand the sources of long-term and short-term borrowings of center and the states. And just like how question has been asked with respect to zero coupon bonds as well as commercial paper, which was in news, we can expect questions related to important bonds in news, specifically bonds such as the masala bonds, social impact bonds, elephant bonds, and so on. Now, coming to the next question, the question here is if another global financial crisis happens in the near future, which of the following actions or the policies are most likely to give some kind of immunity to India? This particular question has been asked from theme of external sector. This question is highly conceptual, and this particular question is based upon the interpretation of the knowledge gained by the students as part of the exchange rate management. As we can see in this particular question, you have three statements. If you have to find out as to which statements are correct or which statements are wrong, you need to have information related to three different aspects. These three aspects are interrelated to each other. First and foremost, you need to have a conceptual understanding of what factors can contribute to currency crisis. That is, what factors can lead to a sudden appreciation or depreciation in the value of Indian currency. Now, this particular aspect has been asked in our prelims test series program. Secondly, you should have an idea of the factors which have caused the global financial crisis, in particular, how the failure of Lehman Brothers in USA had aggravated the financial crisis. And in order to know whether the third statement is correct or not, you should have a conceptual understanding of capital account convertibility and its implications. See, with respect to first part as to what factors contribute to the currency crisis, not only this has been asked in our prelims test series program, this has also been discussed in much greater detail in our QIP module. Here we have covered aspects such as what exactly is rupee depreciation, rupee appreciation, when does the rupee appreciate or depreciate, what factors contribute to rupee appreciation and rupee depreciation, and more importantly, how it affects the Indian economy. So based upon the factors that contribute to the currency crisis, one would have easily got to know whether the first statement which is given here is right or wrong. See, it says not depending on short-term foreign borrowings. See, if we depend more upon the short-term foreign borrowings, obviously it will lead to a greater amount of exchange rate volatility. So obviously, the statement which is given here is correct. The second statement says opening up to more foreign banks. See, if you look at what actually happened in the global financial crisis of 2007-8, you'd get to know that the failure of large financial institutions, including banks, actually aggravated the global financial crisis. So the failure of Lehman Brothers in USA, which had a global presence, in turn led to the spread of the financial crisis from USA to other economies. Particularly, Indian economy was not so much affected as compared to the other economies. This is because in case of India, the banking system has come to be dominated by more public sector banks who account for almost around 70 to 75% of the banking assets. So since the banking sector in case of India is dominated by the public sector banks, so even though Indian economy got affected by the global financial crisis, it did not get as affected as other advanced economies. So you should understand that if the foreign banks with global presence fail in other countries, this has a tendency to affect even the Indian economy. So if we open up to more foreign banks, India would have less immunity from any global financial crisis which can arise in future. So this statement here is wrong. Third statement says maintaining full capital account convertibility. See, in QIP module we have discussed about the rupee convertibility. In particular, we have discussed about the rupee convertibility on the current account transactions and the rupee convertibility in the capital account transactions. Rupee convertibility basically means ability to convert rupee into foreign currency and vice versa without any kind of unnecessary restrictions. India has adopted full rupee convertibility in the current account transactions such as imports, exports, remittances, etc. However, India has adopted partial rupee convertibility on the capital account transactions. This is so because if India adopts full rupee convertibility on the capital account transactions, then this can lead to a greater amount of volatility in the exchange rate. That is why India has imposed restrictions on the foreign direct investment. These restrictions are in terms of sectoral cap, list of prohibited sectors. We do have restrictions on foreign portfolio investment and so on. So, if the Indian economy adopts the full rupee convertibility on the capital account transactions, it will not only lead to a greater amount of exchange rate volatility, but it will also lead to the spillover of the future global financial crisis into the Indian economy. So, coming back to the question asked in Prelims 2020, the statement says maintaining full capital account convertibility, which obviously will not give immunity to India from the global financial crisis in future. So, you can rule out this particular option. So, we are left with only the first option, and hence the answer to this particular question is A, that is 1 only. Now coming to next question, the question here is with reference to international trade of India at present, which of the following statements are correct? This question has been asked from theme of international trade, and the nature of question is it is based upon the current affairs. See, if you have to answer this particular question correctly, you should know certain basic details about India's balance of payment, in particular, the present status of current account and capital account. Apart from that, this is a classical case of UPSC question wherein you can get the right answer without knowing whether all of these statements are correct or not. Now, for example, if you read the second statement says that India's imports of iron and steel, chemicals, fertilizers, and machinery have decreased in the recent years. Now, without knowing whether this statement is correct or not, you will still be able to get the right answer to this particular question. How? Now, for example, upon reading the first statement is India's merchandise exports are less than its merchandise imports. Now, if you have been reading the newspapers regularly, you would get to know that unlike China, which is majorly an exporting country, India is majorly an importing country. So, in case of India, usually imports are much higher than the exports. So, you would get to know that the first statement which is given here is correct. Now, try to apply the elimination method. By applying the elimination method, you can easily rule out option B and option C. So, we are left with option A and option D. So, since you don't know whether the second statement is correct or not, you have to find out whether the statement number 3 and statement number 4 are correct. See, in our QIP module, we have discussed in detail about the components of balance of payment as well as the present status of the current account and capital account. Balance of payment is basically a systemic record of economic transactions between the residents of a country and the non-residents for a period of 1 year. So whenever the foreign currency comes into India or the foreign currency goes out of India, all such transactions are recorded under the BOP. Under BOP, we have current account and the capital account. Current account in turn has the balance of trade and the balance of invisibles. And the capital account has FDI, FPI, external commercial borrowings, loans from multilateral institutions, and so on. So in case of India, usually the current account, it is in negative. That is, normally we have the current account deficit. This is so because the balance of trade, it is usually negative, whereas the balance of invisibles, it is positive. The balance of trade is negative because our imports are much higher than the exports. On the other hand, our balance of invisibles is positive because India is a net exporter of services. That is, the export of services is much higher than the import of services. That is why we have the current account deficit. The capital account, usually in case of India, it is in surplus. This is on account of the fact that India has been able to attract a large amount of foreign direct investment as well as the foreign portfolio investment. So this information alone was sufficient enough to answer the question that was asked in Prelims 2020. Now if you go back to the question, the third statement says India's export of services are more than its import of services, which as we have discussed is correct. The fourth statement here is India suffers from an overall trade or the current account deficit, which once again here is correct. So the correct answer to the question asked in Prelims 2020 is D, 1, 3 and 4. So here we have arrived at the right option without knowing as to whether the statement number 2 is correct or wrong. So what are the key takeaways from this particular question in order to enhance your preparedness level for the upcoming prelims examination? See, usually in prelims, questions are asked with respect to trends in the important macroeconomic indicators. Here we have seen the trends for the current year, particularly with respect to the international trade. Accordingly, we can get questions with respect to trends in other macroeconomic indicators, in particular the GDP growth rate, the fiscal deficit, tax to GDP ratio, investment, savings, etc. Now, the trends in these important macroeconomic indicators are highlighted in the economic survey of that particular year. So, if you go to the economic survey, that alone should be sufficient enough in order to answer such questions related to the important trends. Now, coming to our next question, the question here is, along with the budget, the finance minister also places other documents before the parliament, which include the macroeconomic framework statement. The aforesaid document is presented because this is mandated by. So basically this question requires you to identify as to under what provisions does the government presents the macroeconomic framework statement. Is it presented in line with the provisions of the parliamentary convention, whether this is mandated by the Indian constitution or whether it is mandated under the FRBM Act? This question has been asked from theme of taxation, in particular from the union budget. This question is conceptual in nature. If you have to answer this particular question correctly, you need to have information about two things. The first thing is about the documents presented as part of the union budget and what are the constitutional and the legal framework for the presentation of these documents. Similar to the question that was asked in Prelims 2020, we had asked a question in the Prelims test series. The question in our Prelims test series program was, which of the following documents are mandated to be provided as part of the union budget by the Indian Constitution? So here the UPSC had specifically asked about the macroeconomic framework statement, but in our Prelims test series program, we had asked as to which documents have been mandated under the Indian Constitution. Accordingly, as you can see in the options, we had placed the macroeconomic framework statement. So basically, you have to understand that the annual financial statement, the demand for grants, and the finance bill, these three documents are mandated under the Indian Constitution. The macroeconomic framework statement and the fiscal policy strategy statement, they are mandated under the FRBM Act. The same was provided even in the explanation to this particular question. So the answer to this particular question was 1, 2 and 3 only. So by easily solving this particular question in the prelims test series, we would have got the right answer to the question which was asked in Prelims 2020. The right answer here was the provisions of the FRBM Act. The same aspect was discussed even in our QIP module, wherein we have discussed that under the FRBM Act, the government is required to present 4 documents. These 4 documents are the medium-term fiscal policy statement, fiscal policy strategy statement, macroeconomic framework statement, and the medium-term expenditure framework statement. Out of these 4 statements, the first 3 statements are presented along with the budget documents, whereas the 4th statement, that is a medium-term expenditure framework statement, this is presented in the session immediately after the budget session. We had also discussed the targets under the FRBM Act and the grounds for which the fiscal deficit can be exceeded. So what can we learn from this particular question asked in Prelims 2020? See, the topic of union budget is considered to be multidimensional in nature because questions can be asked both from the perspective of Indian economy as well as Indian polity. Apart from that, in previous year prelims, a number of questions have been asked with these two aspects as well. So, in order to prepare for this particular topic, from the perspective of Indian economy, you have to focus upon the components of revenue and capital account, the various types of deficits such as the fiscal deficit, revenue deficit, effective revenue deficit, and so on, the salient features of FRBM Act, the differences between the fiscal stimulus policy and fiscal consolidation policy. From the perspective of Indian polity, you should know the details about Article 112 of the Indian Constitution, different types of accounts as mandated by the Indian Constitution, that is the Consolidated Fund of India, Public Account of India, Contingency Fund of India, difference between a full-fledged budget and the interim budget, the various stages during the passage of the budget, and you should also focus upon the important initiatives of the budget in whichever year you are appearing for the prelims. So since the budget is going to be presented on the February 1st of 2021, accordingly you would have to focus on this year's union budget in order to prepare for the upcoming prelims examination. In particular, you have to focus upon the important schemes and policies announced in this year's union budget apart from the important taxes in the news. Now coming to our next question, the question here is, in India, which of the following can be considered as public investment in the Indian agriculture? This question has been asked from theme of government policies, particularly with respect to the Indian agriculture. The nature of question is conceptual in nature. See, this is a classical UPSC question which may seem difficult when you see it for the first time. But if you spend some time on this particular question and if you apply the knowledge and do a intelligent guesswork, you would be able to get the right answer to such a question. See, the normal tendency of the students is when they see the question for the first time, the question may seem difficult and they leave out such questions. But if you spend some additional time on such questions, through application of knowledge and intelligent guesswork, you would be able to get the right answer. So let's understand as to how you can arrive at the right answer through the application of the knowledge and the intelligent guesswork. See, I hope you must be knowing as to what exactly constitutes public investment. Public investment is an investment which is for a longer period of time, which means it is long term in nature and it enhances the productive capacity of an enterprise. So among the options which are given here, you should try to identify as to which expenditure undertaken by the government of India is long term and would enhance the overall productive capacity of the Indian agriculture. Among the 6 options which are given here, right away you can choose option number 3 and option number 6 as correct. Social capital development may be in form of government assistance to the self-help groups, the farmer producer organizations, the milk cooperatives, etc. This can be considered as a long-term investment which would enhance the overall productive capacity of the Indian agriculture. Similarly, the government's expenditure in setting up of the cold chain facilities would enhance the productive capacity of the Indian agriculture. So option 3 and option 6 are perfectly right in this particular case. So if you apply the elimination method in this particular case, you can easily rule out option A and option B. So you are left with option C and option 6. Now, if you look at option number 2 here, option number 2 says computerization of the primary agricultural credit societies. Now this option you can keep it aside as of now. If you look at the option D has all of the components. Now look at the component of the free electricity supply to the farmers. Obviously, the free electricity supply to the farmers would not be considered as a public investment. Rather, it would be considered as a kind of subsidies given by the Indian government to the farmers. The same can be said about the waiver of agricultural loans as well as the fixing of the minimum support price for various agricultural commodities. So, through this application of knowledge as well as intelligent guesswork, you can easily arrive at the right answer. The right answer here would be C, that is 2, 3 and 6. Apart from that, in our economic survey video analysis which has been uploaded on the YouTube, we have discussed in detail as to what constitutes the gross capital formation, that is investment, and what constitutes the expenditure in the Indian agriculture. Investment in the Indian agriculture, as discussed before, it is long term in nature. It enhances the productive capacity of the Indian agriculture. It is inclusive in nature, that is, it benefits all the farmers. Whereas subsidies include the minimum support price, subsidies with respect to water, subsidies on the fertilizers, subsidies on the electricity, and so on. Further, in our economic survey video, we had clearly highlighted the fact that the amount of government investment in the Indian agriculture, it is hardly around 2.2% of the agricultural GDP. But the Indian government is spending huge amount of money on providing agricultural subsidies. This value is as high as around 8.2% of agricultural GDP. Accordingly, in our economic survey video analysis, we had highlighted that the government of India needs to rationalize all of these subsidies, and whatever money it is able to save, that money should be instead diverted towards enhancing the public investment in the Indian agriculture. Now coming to the next question. The question here is, if you withdraw rupees 1 lakh in cash from your demand deposit account at your bank, the immediate effect on the aggregate money supply in the economy will be. This question has been asked from theme of banking and finance. This question is conceptual in nature. If you have to find out the right answer to this particular question, you should have basic knowledge of what constitutes the aggregate money supply in the economy. See, in our QIP module, we have discussed as to what constitutes the aggregate money supply in the economy and what are the measurements of the money supply. As you can see, the aggregate money supply in the economy constitutes the currency with the public, the demand deposits with the banks, post office savings deposits, time deposits with the banks, which can be in the form of fixed and recurring deposits, and the time deposit with the post offices. So the question says that if you withdraw 1 lakh rupees from your demand deposit account, what will happen to the aggregate money supply? In this particular case, the aggregate money supply will remain unaffected. This is so because when you withdraw 1 lakh rupees in cash from your demand deposit account, the aggregate money supply remains unchanged. The only classification of this rupees 1 lakh would get changed. Earlier, this 1 lakh was accounted under your demand deposit account. Now it will be accounted as currency with the public. So this was a very simple question asked in UPSC Prelims, and this question could easily be solved through the basic knowledge of what constitutes the aggregate money supply. So what can be learned from this particular question asked in Prelims 2020 in order to prepare for the upcoming Prelims examination? See, repeatedly in the UPSC Prelims, questions have been asked with respect to the money supply. For example, in one of the earlier Prelims, question was asked with respect to the money multiplier concept. Apart from that, question has also been asked with respect to decreasing order of liquidity of each of these components of the aggregate money supply. Hence, in order to prepare for this particular theme related to money supply, one would have to refer to the NCERT chapter of money and banking. In this particular chapter, various concepts related to money supply have been discussed in much greater detail. Some of these concepts include the velocity of money, currency deposit ratio, reserve deposit ratio, narrow and broad money, high powered money, and so on. So if you read the NCERT chapter on money and banking, that alone should be sufficient in order to answer these kind of questions which may appear in your upcoming prelims examination. Now coming to the next question, the question here is, in the context of Indian economy, the non-financial debt includes which of the following? Now most of the students have found this particular question to be little difficult in the prelims examination. So let us understand the answer to this particular question. See, before discussing the answer to this particular question, let me tell you that neither the RBI nor the government of India defines as to what exactly is the non-financial debt. The Department of Economic Affairs publishes a report about the status of the public debt management in India. This report does not has a reference to the non-financial debt. So whatever sources which we have in order to answer this particular question, these sources are from the media. In particular, this is an article from the Indian Express which basically highlights about the non-financial debt. See, in any economy, there are basically two sectors. First one is the financial sector that basically includes the banks and various financial institutions. And the other sector is a non-financial sector. The non-financial sector includes the households, government bodies, non-profit organizations or the NGOs. So when we say the the non-financial debt refers to the overall borrowings made by the households, government organizations and the NGOs that are outside the purview of the financial sector. And what does this non-financial debt include? It includes loans to the households made in the form of housing loans, the amounts which are outstanding on the credit cards, the banking loans to the companies. It also includes the outstanding corporate bonds. If you look at the options which are given here, the first option is housing loans owed by the households, amounts outstanding on the credit cards. So both option number 1 and option number 2 are perfectly correct. The option number 3 says the treasury bills. See, as discussed in the definition of non-financial debt, it also includes the borrowings made by the government of India. So ideally, even the treasury bills should be part of the non-financial debt. So in most likelihood, the answer to this particular question should be D, that is 1, 2 and 3. But with a note of caution, I want to reiterate this important aspect that this is the answer which we feel is correct based upon our interpretation. Ultimately, the right answer would be given by UPSC when it releases the answer key.